The reality is for most business owners that I see, they've got an accountant that they've outgrown. And what are the symptoms of that? Is that their accountant is transactional and reactive. For many business owners, usually when they're getting started, they don't want to spend too much on their accountant, right? They want to do the bare minimum. They need to get their business activity statements done, they need to get their tax returns done, their financial statements, and what that usually means is they've got an accountant that they're meeting once a year. And it's usually after the financial year is finished, which there's no opportunity for them to optimize their tax at that point. And it's too late. Once the financial year is over, the opportunity for tax planning is completely gone. And not all accountants are made the same. There are accountants who are phenomenal at compliance. They're really good at ticking the boxes and keeping you out of jail and keeping you in good stead with the ATO. But that's not what most successful 7- and 8-figure business owners need now. And it's an opportunity for them to go through an upgrade. So what do they need to do differently? Well, first and foremost, they need to review their tax structure. The amount of business owners who are at 7 and 8 figures who have outgrown their tax structure. I've seen business owners that are still running as a sole trader or a partnership. That they're running their business through a discretionary trading trust, which is causing tax issues every single year. They own shares in their company directly, individually, which means that they can only receive the dividends that are being distributed. They've got no flexibility around tax planning. These are common issues that I see. And the reality is what often business owners don't know is they can actually restructure quite easily. There's obviously a cost associated with it, but it's relatively straightforward, and we do this all of the time for our clients. So the first thing is reviewing the structure. The second thing is having a proactive tax plan. So the proactive tax plan is first and foremost about ensuring there's no surprises, because tax is a consequence of making money. If you're going to grow a bigger business and you're going to make more profit, you are going to pay more tax. It's just an inevitability. But we want to avoid paying bonuses by understanding the rules and forecasting the decisions and actions that need to be made along the way to ensure we're taking advantage of those rules. And what does that require? Is that usually at the beginning of the financial year, we create that forecast over the next 12 months. Every quarter, usually in line with our BAS period, is that we review that forecast and we make adjustments. And that ensures, one, we're putting enough money aside for tax, but two, that we're taking advantage of opportunities that come up as we go. Whether that be instant asset write-off, whether that be R&D tax incentives, whether that be EMDG grants or other things that we can be doing to offset our tax and be a bit more strategic. These are the things that a good strategic accountant will do. And then thirdly is having end-of-year tax planning. So usually by the time we get to April or May, we have met with all of our clients and we've basically worked out what are the final things that we need to do before the end of the financial year to optimize things. Do we put extra into super? Do we distribute to lower income beneficiaries? Do we set up a bucket company? There are so many things that we have up our sleeve that we can implement, but they can only be done proactively. And if you've got a dinosaur accountant that you're only meeting once a year, you're not doing any of those things.